So we've taken a look at the sort of structure of commercial and investment banks so far, and so now we're just going to take a look at some of the supervision and regulation that's imposed on sort of the banking sector, so both investment and capital commercial banks, and then take a look at how this then affects the risk that is faced by both of these sort of financial institutions. So we'll take a look at regulation and prudential supervision that exists within the banking sector. We'll then take a look at what's known as the capital adequacy requirement for commercial banks. And then we'll take a look at commercial banks versus investment banks and see where the risk lies. So first of all, regulation and prudential supervision. So bank regulation aims to constrain the activities of the banking sector through legislation, whereas prudential supervision is more about imposing standards to ensure soundness and stability. So it's important to understand the differences between regulation and supervision. So regulation is really about legislation, and it even sort of includes supervision. So it's all about constraining activities, whereas prudential supervision is more about supervision as a whole and ensuring just the stability of the banking sector and the financial system. So there's 4 main players in banking regulation. There's first of all the RBA, which is responsible for the financial stability and soundness of the payment system. There's APRA, which is responsible for the regulation and supervision of deposit-taking institutions, so commercial banks. There's ASIC, which looks at the regulation and supervision in terms of market integrity within the context of corporations law. And finally, there is the adequacy, which really concerns itself with monitoring businesses in relation to competition policy within the Trade Practices Act, and especially within the banking sector looks at the 4 pillars policy. And the 4 pillars policy basically states that the big 4 banks, so Commonwealth Bank, ANZ, they can't merge with each other. So we have to keep the 4 pillars basically, because the idea is that if ANZ and Commonwealth were to merge with each other tomorrow, every other bank would be wiped out essentially, and it wouldn't be a very competitive market. So we have to keep those 4. What that does mean for the market is that whoever becomes the 5th bank is normally taken over by one of the big 4 very quickly. So so they're the 4 main players within the banking regulation. So the capital adequacy requirement is the main standard in Australia for commercial banks. So it applies to commercial banks only. So we're not talking about investment banks here. The reason why it doesn't affect investment banks is due to the off-balance sheet advisory services that they're primarily engaged in. So this is mainly dealing with the balance sheet activities. And what it basically says is that losses must be written off first against profits and then against capital, but it can never be written off against liabilities. And what this means is that banks must have sufficient capital to absorb these losses if they can't write them off against liabilities. In sort of quantitative terms, it means that at a minimum, banks must maintain a risk-based capital ratio of 8% of the total risk-weighted assets at all times. So risk-weighted assets just means that riskier assets are probably going to have a higher value, even if their book value is lower. And at least half of these risk-based capital must take the form of Tier 1 capital, and the remainder can be held as upper Tier 2 or lower Tier 2 capital. Now, Tier 1 capital has essentially 4 main characteristics. It must provide a permanent and unrestricted commitment of funds. It must be freely available to absorb any losses. It mustn't impose any unavoidable servicing charge against earnings. And it must rank behind the claims of depositors and creditors in the event of any bankruptcy. So some examples of Tier 1 capital would be retained profits and some ordinary shares and even some reserves. Tier 2 capital consists of things like preference shares, and the reason why these aren't Tier 1 capital is because they have this obligation to pay a fixed dividend. So it's not freely available, and it does have sort of that servicing charge against earnings. So now that we've looked at some of the regulation that's faced by the banking sector, and also the regulation that it faces and the structure, we have to look at, so where is the risk? In commercial banks, it's a highly leveraged organisation, which means it does have quite a lot of liabilities, but unlike other businesses where high leveraging provides a risk, because this is part of its operating sort of structure and not its amount of debt, it's not as much of a risk as it would be for other companies. They have got that higher degree of regulation than investment banks, which normally means there's a lower degree of risk because there's more supervision. With investment banks, they don't have that high leveraging, but the main factor that we're going to talk about on is risk is this off-balance sheet activities. And investment banks have practically all of their activities in the off-balance sheet. Now, balance sheet activities provide transparency. So with investment banks, we have very little transparency, and this translates into a much higher degree of risk than commercial banks. However, with commercial banks, it is said that their off-balance sheet activities is 5 times the notional value of balance sheet activities. So I'm not to say commercial banks have zero risk. They both have very high degrees of risk in some way due to this off-balance sheet activities and the structure of them. So that's an important fact to note.